Hi guys, can you guys hear me?
Yes, we can.
Oh, there's an echo.
A slight echo, but we can hear you.
Okay, thanks, Fadil.
Alvin,
Yeah.
Alvin, we take Fadil's question immediately after his presentation because he's not staying for the Q&A, yeah?
Okay.
Okay, thanks. Okay, we're
Stay.
going to pardon?
What do you say?
We take his we will do his Q&A immediately after his presentation because he's not staying for until the end of the webinar.
Okay. All right.
Okay, so we will be letting the participants in now. All right. Okay, girls can admit everyone already.
Ladies and gentlemen, good morning. Can you hear me? Ladies and gentlemen, good morning. We will begin the webinar in about 5 minutes time to allow more people to to yeah to be admitted into the meeting room. So just give us 5 minutes and then we will begin. Thank you. Okay. Okay. Good morning, ladies and gentlemen. While waiting for the others, I think we shall begin the webinar this morning. Once again, welcome to the webinar entitled Navigating the Polymer Market, which will provide exclusive insights and updates on plastics raw material pricing. This event is brought to you by MPMA in collaboration with Argus Media. And to begin with, let me run through the webinar etiquette for this morning. We have muted and turned off video for all participants to ensure no disruptions throughout the webinar. We will allow participants to turn on their mic and video during the Q&A and photography session. Participants may post questions related to the presentations in the chat box. The speakers will only answer questions that are clearly written and based on the presentations. And also we will answer all the questions that were submitted via registration. We will answer those questions first for today. Kindly refrain from marketing your goods or services in the chat box. The chat box is only for queries relevant to the presentations, and the organizer, MPMA, reserves the right to remove participants who run afoul of the webinar etiquette. Okay, with that, let us look at the agenda for this morning. Okay, this is the agenda. Please note that we will do a Q&A after the first presentation on key drivers driving global markets today. And then for the other presentations, the Q&A will be done after all the presentations. Okay, so Q&A only after the first presentation. And then for the remaining presentations, the Q&A will be after all the other remaining 1, 2, 3, 4 presentations. Okay, with that, before we start the webinar proper, shall we do the group picture first? Can I ask ladies and gentlemen to kindly turn on your video so that we can take a group photo shot of everybody? Please turn on your videos. Girls, are we ready, girls?
Just wait for a little while more for everyone to turn on their videos.
Okay.
Give you a few more seconds. I see some familiar faces. Hi, Pixie. Hi. Yeah, I think that has stopped. Okay, no, still. Okay, hold on. Just a few more seconds. Okay, maybe we can take the picture now. So
Okay, let's all smile to the camera, please.
Okay, done.
With that, huh?
Yes.
Thank you. Now let us move into the introduction for our moderator for this morning's session. Our moderator this morning, Mr. Alvin Ang, is the chairman of MPMA Northern Branch. He is also the executive director of Tongwan Industries Berhad since December 2013. He was instrumental in planning the listing of TGI on the Kuala Lumpur Stock Exchange and has contributed immensely to the growth of TGI, especially in the fields of finance, taxation, project planning and implementation, information technology, operations, and marketing. With that, let me introduce our first speaker for today. Our first speaker is the Senior Vice President, Strategy and Business Development at Argus, focusing on expansion sectors and Asia strategic initiatives. Before joining Argus, Fadil was head of Middle East markets for ICIS in Dubai, where he led market engagement and strategy. He also previously worked for Channel News Asia, Hill and Associates, and the ONS group of companies. He holds a master degree from INE Business School and the National University of Singapore. He is currently a doctoral student at Warwick Business School. And with that, I invite Encik Muhammad Fadil to make his presentation.
Thank you very much, Encik Francis, and I want to say a big thank you to MPMA for inviting Argus and all the members that are here today. I also want to say selamat pagi and selamat berpuasa to those observing the fasting in Malaysia. What I'll do today is I have different colleagues speaking about their markets, but I wanted to kick off with a chemical overview. Obviously, a lot of you know that there's been significant changes since COVID, and last year as well, there was a lot of fluctuations. I think this year is unique. Next slide. We are coming into a period where there's a lot of uncertainty in the market. Concerns on inflation, high interest rates, and things like that. So I'll touch on that. But before I begin, probably the slide before that, I wanted to just introduce Argus for those of you who are unfamiliar. We have been around for more than 50 years with a very proud legacy of commodity markets. We cover, as you can see, I know it's a bit small, but oil, natural gas, biofuels. But on the chemical side, we are very established. We started through acquisition of DoIt in 2012. Some of you may know DoIt. That comes across the value chain. So looking at olefins, polymers, aromatics, butadiene. We've also grown into covering more on the recycled polymers, which my colleague Akash will speak about. We've launched propylene oxide. So I just want to give you a huge understanding of where we are. I think in terms of presence, we're all around the world. We have around 29 offices. Close to Malaysia, we are in Singapore, so only 40 minutes away. And we welcome you to visit us at our office at Raffles Place for more engagement. And we also, frequently come to Malaysia, and we're holding, for example, a carbon event in KL in May after the Eid holidays or the Hari Raya holidays. Next slide. So this is what I mentioned, we cover across the value chain. And I think today our focus is on chemicals, but we draw on that experience from our colleagues across the different desks to enrich our knowledge and expertise on the chemical markets. So again, integrated upstream to downstream. Next slide, please. So this is again a different way of putting it together. I just want to say I forgot to mention methanol. Methanol is key for us as well. We are the benchmark in the US, and we have pockets of usage also in Asia. We also launched a European contract price in Europe last year, which is going very well. And of course, aromatics, benzene, toluene, xylenes. Argus is also very well recognized in the paraxylene space, where we're used significantly in Northeast Asia. Next slide. I think this is just another way of putting it, but just the kind of below as well, the last one. Polyurethanes, we also look at isocyanates and PO. That's mainly used in the foam mattressing market that we cover as well. Thank you. So just to kind of give a very brief overview, market reporting is the weeklies or dailies that we provide. I think since COVID, there's a lot of interest to understand what's happening, in future, where the view is. We provide outlooks that roll every month over a 24-month period. And if you're interested in what's going to happen in 2035, 2040, we also provide that information from a demand supply perspective on our analytics. Yeah, I think we can go to the next slide. Okay, great. So let me kick off with the matter at hand, which is key market movers. As I mentioned, we have a few challenging days ahead in terms of uncertainty in the market. And our team, we cover it across the board, and we look at the kind of nitty-gritties and the nuances of the market. Next slide. So I think the key thing to note is last year, if you can see here on the left side, the world manufacturing PMIs is just was a bit of a roller coaster, to be honest. If you look at China over the last few years, you see that big dip in red there in January 2020. Unsurprising because that was the height of COVID lockdowns, but things have recovered. I think the key thing about China, which Rita, my colleague, will speak about later, is the uncertainty around demand. Last year, the key message was around China going through deflation, and deflation is such a foreign word for us because everyone is talking about double-digit inflation or above 5% inflation, but the Chinese demand has not recovered in 2023 in the way many people expected. So you can see the one in red there was hovering pretty much below 50. And there was a little bit of a jump above 50, but the message is that we are still waiting for that big China recovery after Chinese New Year of last year. I think if you look at the rest of the world, the US as well, since the Inflation Reduction Act has gotten, of course, stronger PMIs, but that's again still very, very volatile. If you look to your right, I think commodity prices as a whole has weakened, but the big news is it's still well ahead of where things were in 2019, where it was before pre-COVID. I think what I want to draw your attention to on the graph on the right is the orange, which is the olefins. And olefins, of course, has pretty much, although you can see a little bit of jaggedness there, but it's pretty much flat over a longer period of time. But if you compare to markets like fertilizers, or you compare to markets like energy, which refers to oil and other upstream products, there still remains that variance that we see as well. So I think the message or the title captures it very well, pulled across two different directions. And what we expect in 2024 is probably more of the same. And I think demand more than supply, which I'll speak about later, still remains the big question mark. Next slide, please. So I think this is a hot topic in Malaysia. I was in KL a few months ago, and I was surprised at how expensive things were. Even at the nasi kandar shop, things were a lot more expensive than before when I visited a year ago. And I think I just wanted to mention that inflation is a key thing in the plastics industry. And if things continue to get more expensive and consumers start to cut on demand, we will see that impact on the downstream market. So where I think again to your left side, if I start with inflation, I think what we are a little bit more optimistic about is, we are watching what the Fed is doing in terms of interest rates, which I'll speak about a bit later. But inflation, of course, has shown a bit of cooling down with more aggressive movements from the Fed and also central governments across the world. But still, it's many players that we speak to, producers, converters, are quite uncomfortable with where inflation still is, and they want to see a real softening of inflation to kind of spur a lot of what we see in terms of consumer demand. I think in terms of policy, I think this is a very, very interesting slide. We are waiting. I think the Fed has, of course, moved up, interest rates, over the last few times, and seeing whether there's potential of interest rates coming off across this year. I think it's also important to note in the US is also election year. So there is a lot of momentum in where we see in terms of the decision making and things like that as well. The other thing that's not mentioned here is the dollar. I think a lot of emerging currencies are also impacted by inflation, by interest rates, and other macroeconomic fundamentals. I think the key thing is a market like Malaysia, Indonesia, that's really, really key in terms of where the dollar is. We also see in South Asia, markets like India, South America, Brazil, Argentina, also vulnerable to any significant hikes in interest rates compared to their local currency. Next slide. So, what we feel is quite key is also that this is not just inflation, interest rate, dollar. There's a lot more fundamentals to look at these days. And one of the key fundamentals that we saw during COVID was, of course, freight rates. And freight rates coming up in significant measures, in some cases 10 times more than they were the year before. This year, of course, what we've seen is that supply chain continues to be coming to the fore. We've seen disruptions on the Red Sea earlier part of this year, and my colleagues will probably talk a little bit more about that from the polymer context. but that is disruptive. And we see that the pressures, of course, are nudging higher and higher. It adds to more costs, it adds to the inflationary concerns. So there is this notion now of freight inflation, which means that on top of your costs, variable costs, you need to consider that, hey, maybe the risk premiums are higher. We need to pay a bit more on freight than we used to before in a market for polymers that's pretty depressed at times. Next slide. So, where does 2024 land? It's a big question. And I think our view is, this is a year where many countries are going for elections. That's going to play a part as well in terms of where the economy lands. I think our view is that pretty much flat, in the next few quarters until we have more certainty. Um, I think where we see issues with would be on your right, which is the advanced economy. I think Europe still, there's, issues with inflation, as I mentioned, but also, if you look at, the energy security aspect after what's happened with Russia and Ukraine, natural gas remains a big issue. Of course, with what happened in Nord Stream, a few months, I would say more than a year ago now, and of course, the US as well. We will be waiting to see where the kind of growth will likely come in post the Inflation Act, and of course in November, where we have more certainty on the political situation as well. Next slide. So I think the other thing that we see on the supply side, and I mentioned demand quite a lot, but on the supply side, crude prices remain a lot higher than what many people are comfortable with. And we are, looking at OPEC productions, particularly OPEC plus production, very closely. I think announcements from Saudi and the rest of the OPEC members. And if you can see to your right side again, we expect crude prices to be, slightly above $80 for 2024 and 2025. There seems to be no sign of, crude prices falling below 50, which I'm sure a lot of people are hoping because it has impact on the more downstream demand. But crude prices still remain, on the above 80 levels, and that of course has impact on olefins, polyolefins, and the markets that you look at. Next slide. So, I think this is key. I think in an Asia context, we want to see China, and where China is going to land. I think there's a lot of things where, we are used, 10 years ago, Chinese GDP was at double digits, and now we're talking about 3, 5, 6% if we're lucky. And there is also a question mark on the real estate, how things would land on the real estate sector. And also, how there would be levers that China can use to boost kind of demand and growth in China. I think the general consensus of what we, the team in August hears is that it could be flat to slightly slower. I think my colleagues in China will talk a bit more later on what that means. And also in terms of import growth, if you look at other markets outside of chemicals, whether it's coal, iron ore, soybeans, in terms of agriculture, that still remains on the muted side. So these are things that I think is important to talk about, it's important to consider, because we work in very interconnected markets and across different commodity groups. Next slide. So the key risks, of course, would be, the weakening aspect. The debt is still, issues in many emerging as well as developed countries. The debts are rising, and I think this is something that we want to look at. I think one of the key things that our economists in London looks at is that some of the debt-prone economies, they have significant populations, 700 million, a lot of demand for oil. If things don't go as well, there is the contagion effect, from the developing economies. And I think Southeast Asia is not immune to that. Neither is South Asia or other markets that we look at. So please, I think this is something to continually monitor. And Argus, of course, is well placed. We cover a lot of these aspects in our weekly reports, for example, if there's certain areas of focus to consider. Next slide. Yes, this is something really interesting. And I think I've alluded to it a couple of times. 40 countries will be holding elections in 2024. And I'm in Jakarta right now in Indonesia. I think Indonesia just finished their elections. But we have a lot more coming up next month. South Korea, India as well. I think there's an announcement of a more staggered election coming up. I think later in the year, I think the one to watch in November is USA, South Africa, Egypt, another huge economy is going to be going on elections. And this has impact in the mood, in the cycle, in the sentiment. And I think we see, the whole talk about energy transition remains. But yesterday there was a announcement or a speech by the CEO of Aramco on how energy transition is faring as well. So I would encourage you to look at that. But the key thing is volatility in a very elevated political climate. So we will continue to watch this in terms of how it will play out in the chemical markets as well as the polymer markets. Next slide. So that's it from me. I can't stay for the Q&A, but I'm happy to take questions that you have on the polymer markets, any thoughts that I mentioned on inflation and the macroeconomy. Over to you, Alvin.
Oh, thank you, Mr. Muhammad Fadil. I think we've got some questions that is sent to us, that is addressed to you. Let's start with I think question number 2. With the rising of EVs, which is electric vehicle, petrol will be less in demand. Will this help in reducing polymer costs?
I think that's a very good question. Related and also in unrelated in some sense. I think the electric vehicle movement continues. I think a lot of the key companies, particularly in the US, Tesla, Ford, moving into the electric vehicle demand. What will be key would be to watch whether this continues to improve on scale. I think China as well is at the forefront of the electric vehicle demand. I think the question probably refers to peak oil, whether oil will peak at some point, given the fact that there's the electrification of vehicles that we see. I think that's still, there's still some ways to go. The market is extremely volatile, as I mentioned in my presentation. And while there is a structural change in how we consume crude oil and oil products and petrochemicals, the narrative where if crude is at 70, we expect polymer to be at 700, that does not land like it used to, say, 5, 10 years ago. So I think we need to take these two things separately. While it's important, I think polymer demand and supply fundamentals have shown a fracture, starting with COVID, from where crude is. So good question, but I would take that probably separately because of the demand and supply fundamental for crude and the demand and supply fundamentals for the polymers and pricing in general. Having said that, I think I've not mentioned on the supply side, there's significant polymer supply coming in here in Asia and Southeast Asia as well, plus other parts of the world. That will actually weigh down on polymer prices because producers in Korea and many parts of the world are running at lower rates because of the disruption between demand and supply. So I would point as a fundamental reason as the new PE/PP supply that's coming to the market.
How do you see the naphtha-based producers? Yeah, they've been suffering losses. I would say hemorrhaging for the past close to 2 years. How do you see this condition moving forward?
Excellent question. I think this is something that we saw, I think I personally saw when I was in Seoul last year, where a lot of the Korean producers are having issues. Of course, this is margins are negative. I think my colleagues will show some slides later on that. I think there's a lot of rumors in the market that potentially there might be consolidation in the market. I think no one can continue to make losses, non-stop for 3-4 years. I think that's not sustainable. I think this is where, again, back to my point on new supply, because a lot of supply, particularly for PP, is coming from PDH, new capacities in China. Polyethylene as well, you're dealing with lower feedstocks from the Middle East, in Saudi Arabia, as well as from the US. So producing as a non-integrated producer, or even as an integrated producer in Asia, is going to be more challenging. So this is a competition of feedstock competitiveness. I agree with you, Alvin. You can't be, continuing for 2 years hemorrhaging, as you say. But this is something where something has to give either through lower operating rates, consolidation, or through certain structural changes in the market.
Having said that, what's the cost difference in terms of naphtha producers compared to the fracking producers in the ethane-based producers in USA, and also the Middle East producers? Do you have any idea on that?
Sure. I think, what we've seen is that the Middle East producers have increased their feedstock costs earlier this year. But still they remain very cost competitive compared to the US players. The US players, of course, benefited from very cheap ethane. That's why they've embarked on new polyethylene expansions since 2017, 2018, that continues till today. I think Northeast Asia remains less cost competitive, obviously, because of the feedstock choice and less feedstock advantage. So I would say, in terms of cost competitiveness, I think the Qataris and Saudis are very, very well placed, despite the increase from Saudi feedstock, earlier this year. I think, of course, the US as well benefits from very cheap feedstock, given the fracking and some of the advancements that we see in terms of new crackers. I think the challenge for the US, though, is on the supply chain, because if you remember, Elvin, in 2019, we saw significant flows of US polyethylene into Southeast Asia, into Turkey, into other markets when supply chain was low. We've not seen that much US polyethylene coming in. And of course, Northeast Asian producers, as you say, the Koreans, less competitive. But I think also if you look at Southeast Asia as well, that's also that challenge. So this remains to be a way where if you are close to your customers, probably regionalization of trade within ASEAN, focusing on neighboring market if you're less cost competitive on the feedstock side.
What we mean is that what is the gap like, in terms of US dollar, say, when naphtha is at 700,
Yeah.
what would the cost of ethane to ethylene, and also Middle Eastern producers are?
I think let me get back to you on that, Alvin, because I don't have the numbers with me. But this is something where as I mentioned, I think the Middle East producers are a lot lower. But I think if you're talking about like more kind of 700, what does that look like? I think it's better for us to put it down on the paper for you.
Okay.
Yep.
All right.
Thank
Do
you.
you see the price delta between the prices, olefin prices, especially polyethylene and polypropylene prices, difference in the US, and Europe, which is relatively higher than in Asia? Would that continue, and why is that?
Sure. Very, very good question. I think first and foremost, I think there's a slight fundamental difference in the way that we see US and Europe. Firstly, these are contract prices for polyethylene and polypropylene on both the European and the US side. So there's always a lag from where we see China prices and where we see markets like India, where it's a lot more liquid, it's a lot more spot, sometimes markets trade on a daily basis. So I think I want to point that out first and foremost. I think in terms of the gap, what we saw in 2020, 2021, there was a significant gap between, say, US prices and China prices. Sometimes the gap was more than $1,000. But I attribute that gap to the freight, because of where we see, the kind of differences in terms of where prices were landing. So we have in our reports, for example, a map of all the global key hubs and where the price is. So I always ask the team, I say, why is US at 3,000 and why is China at 1,200? That does not make any sense, because it opens up arbitrage opportunities. What we've seen, Elvin, is that gap has narrowed. Of course, there's still always a premium, but that gap has narrowed. But I think China still remains one of the lowest prices in the world. Again, as I mentioned, because of supply, excess supply in the market, the renminbi prices, domestic prices impacting the CFR prices, and also trade flow changes. So I think the gap remains to be more and more narrow than what we saw a few years ago. And my personal opinion, this is probably not an argument, but my personal opinion is that that gap will still continue to remain at the levels that we see today.
The delta, how much is that? Do you reckon?
Um,
Say
Ying or Matt,
China
can
and
you
US
confirm?
or China, Europe.
Sorry, I'll just ask my colleagues to support me on this. Matt or Ying, do you have the numbers?
Sorry.
This is for the freight deltas or the
Price delta.
between the different
US.
Europe and say China.
Okay, we will get back to you with this one. We have the numbers in the report.
We have the numbers on the weekly report. So I think historically, if you look at it as well, it's the gap has narrowed. But yeah, let us get back to you, Alvin, on this.
Okay, all right.
Sure.
Okay, all right. Thank you then. Thank you very much.
Thank you so much.
Muhammad Fadil.
Thank you. Thank you, Alvin, and thank you to the MPMA team.
Thanks, Alvin, for the questions. Actually, there was no other questions posted for Encik Fadil in the chat box. So we will proceed to the next speaker. Thank you, Encik Fadil. Thank you.
Thank you, Chief Francis.
Okay, let me introduce our next speaker for this morning. He is a senior reporter handling pricing analysis for polyethylene, polypropylene, and polyvinyl chloride. His focus is on South Asia and Middle East, and he personally launched price assessments for Pakistan, Bangladesh, Sri Lanka, and Nepal in his first 2 years at Argus. He has also presented on global markets at various conferences. Before joining Argus, our next speaker worked at CNBC. He holds a degree in economics from Singapore Management University, and with that, I present Mr. Matthew Rajendra. Matthew?
Thanks, Uncheck Francis. Let me just share my screen first. All right, and good morning, everyone. Thank you for joining us bright and early today. And so my presentation today, I'll be talking about the choppy polyolefin waters that we've been seeing for the past few years and what certain producers and some buyers have been doing to navigate these difficult times. Yeah, so firstly, I'll give an overview of what's happening globally. And then I would like to take some time to focus on India, which has been very often touted as the silver lining during this period of dark clouds. And finally, I'll talk about the impact of freight on the Middle East and on global polymer markets. All right, so firstly, as we can see from the chart, global LLDPE prices rose sharply after dipping during the pandemic. And from what we've observed, this was driven by two main factors. The first was the aggressive restocking in the second half of 2020, following an extended destocking during the height of the pandemic. And secondly, there were supply chain disruptions that kept freight prices elevated. And as we can see from the chart as well, this effect was prolonged and lasted for more than a year. In 2022, we had Russia's invasion of Ukraine that saw feedstock prices soar. And in the second half of that same year, we would see inflation take hold globally, giving rise to high interest rates and strengthening the US dollar. Now, this has had a profound impact in many ways, where firstly, US dollar became more expensive, so importers in developing economies could not import as much volumes as they would like. And secondly, because of the high interest rates, US firms stopped expanding as aggressively as they used to. That's why we started seeing tech layoffs as well. And when money is expensive, spending goes down, and we'll see shortly what impact this has from the US on other regions. And in 2023, we started to see the era of high raw material plastics finally subside as demand shrank on the back of weak global macroeconomic conditions. And of course, entering 2024, we saw Red Sea tensions arise, implicating polymer markets worldwide. In PP, the situation was very similar, but there was one crucial exception here: China. The winter storm in the US in early 2021 prompted exports out of China. And until today, we see Chinese PP exports continuing to dominate major markets as massive new capacity additions come online. My colleague Rita will go into more detail on this later on. Yes, and as I was talking about earlier, with high inflation and high interest rates, we saw plastic imports into the US fall quite significantly from the middle of 2022. So if you can see, this is a chart illustrating the imports of finished plastic goods into the US. And because US consumers reduced their discretionary spend, we could see that the imports from China took the hardest hit. And in fact, right now, what's being said is that Mexico is actually the biggest trading partner for the US, and it's no longer China. And this tallies with what we've heard on the ground. The Argus editorial team last year was in China Plus, and converters were reporting that they saw orders fall by as much as 30%. So whatever happened in the West has had ripple effects into Asia, where the exports of finished goods have dropped because of the macroeconomic conditions in the US. And from what we are seeing now, things will likely stay this way until some stability can be brought to the global economy. So from now until 2032, we will see around 6 million tons per year of new capacities coming online. And out of this, 43% will be in China. We do anticipate demand to grow globally, but new supplies will outpace the growth in demand. And this will keep operating rates hovering at around 85% to balance the new capacity additions with demand growth. Now, the impact of this is far more severe in PP as China leads the push with capacity additions. 80 of the 95 new plants that we are seeing being added will come from Asia, and out of those 80, 65 will come from China. Now, most of these plants will be PDH-based PP plants, and as Fadil and Alvin have alluded to earlier on, there are cost concerns on the back of this, with propane margins mostly being negative. Rita will give you more detail on that later on. But because of this situation, concerns have been raised. Some units may be spared from this as they have integrated refineries with the units, but many of these units are standalone and will have to import propane. All right, now let's shift the focus and look at the silver lining in the polymer markets today, which is India. Indian price movements were very similar with what we saw in global markets last year, with some exceptions here and there. So, for example, in 2021, the Delta variant hit India really hard, and it was perceivably harder than most of the other regions. And as a result of this, polymer demand weakened, dragging down PE and PP prices. Middle East turnarounds in 2023 and 2024 helped support prices slightly in the first quarter of last year and this year. But we saw the rise in prices being more pronounced in 2023. And of course, we can't talk about India without talking about BIS. Last year, we saw the looming BIS implementation pushing buyers to restock aggressively on fears that imports would not be allowed into the country and instead be confiscated. And in India, like the other regions in Asia, other countries in Asia and globally, we will see capacity additions coming online in the next few years. From what we've observed, infrastructural developments will be a major driver for growth in raw material plastics in the next few years. And what we see in PE is major growth in the HDPE pipe sector as projects are underway to improve potable water piping systems. Situation is similar in PP as well, where we also expect capacity expansions. Nayar's 450,000 ton per year plant has been delayed to the end of this year, and GAIL is slated to start up India's first PDH plant in 2025. With construction projects taking place as well, we expect copolymer demand to increase on the back of this. And yes, so with what we've seen in polyethylene, the new BIS and new capacities will both go in hand to strengthen the Made in India initiative. In January, India implemented BIS on polyethylene, but exempted many grades. And the main grades that were affected were HDPE film and blow molding. So your other grades like LDPE, LLDPE, and so on were exempted from the BIS implementation. And now we've heard the Indian government ordering the implementation of BIS on PP and PVC from the 25th of October. And as we've seen in the situation for BIS with PE, it is likely that not all global producers will want to get certified, leaving India with fewer options. So why do I say this? Well, if we look at North America, for instance, initially there was some pushback on BIS certification because of the threat to their intellectual property. As part of the BIS certification, plant inspections need to be conducted, and some producers were afraid that this would give away certain technology secrets or technological processes. But recently, we've seen one North American producer get certified for BIS. And what we are also seeing is in the case of Chinese producers, those producers that applied for BIS PE certifications have had their applications delayed. So the question is, could we also see this in PP and PVC? And if this does happen, the impact would be quite massive because China is a major producer of both PP and PVC, and China is in fact India's #1 import origin source for PVC. And at the same time, BIS will also see more off-spec grades being made available for other regions, as these will no longer be allowed in India. And as we've seen in polyethylene as well, we do anticipate that Southeast Asian producers will be keen to get certified to leverage on the import duty advantages that Southeast Asian origin cargoes have in India. All right, and now on to freight and the impact on Middle East and global polymer markets. So as we all know, freight rates shot up to never before seen highs after the pandemic. Plenty of logistical issues arose because of a manpower crunch, additional COVID restrictions, and vessel and container shortages. But over the years, we've started to see freight prices ease, and the divergence between the different routes have narrowed, and prices have returned to pre-pandemic levels, as what Fadil was alluding to earlier. But as we know, this situation today might not be as narrow as what it once was, say, 5 months ago. Because what's happening in the Red Sea and the Panama Canal now is shaking up freight markets. So as we can see here, the difference in prices can be staggering in some instances. So for example, freight rates from Asia and the Middle East to Europe and Turkey are easily $100 per ton more, while other routes remain much lower. And I believe this would address the question that Elvin was asking earlier on as well. And in terms of what's happening in Panama, we've seen that the issues in Panama Canal are starting to improve. And the big focus today in terms of freight issues are on the Red Sea. So, as I mentioned in the last slide, westbound rates have been high because of these tensions. And just to paint a clearer picture of what's happening, the blue arrows that you see over here represent the traditional routes that ships used to sail to get to Europe and Turkey from Asia and the Mid-East Gulf. So, with the attacks taking place in the Bab al-Mandab Strait, which is over here, ships can no longer pass through into the Red Sea and up through the Suez Canal. So now what's happening is the vessels will instead need to go south and around the Cape of Good Hope, and then back north and then through the Strait of Gibraltar in order to access Europe and Turkey. And because of this, shipments will take around 2 to 3 weeks longer, and of course, costs will be higher. So this situation was worse initially when major shipping lines were rerouting their vessels and taking conservative stances on this to ensure the safety of their crew and their ships. But this has also improved slightly as the Houthi militants are now allowing Asian flagged vessels through. But all in all, the freight rates are much higher than what they were prior to the attacks. And because of what's happening in freight, European and Turkish prices have also risen sharply. So importers were seeing delays in shipments, prompting them to restock further from European sources instead of Middle East sources. Why were there delays? Because now most of the shipping lines are going around the Cape of Good Hope. And because all ships are being redirected around here, there were congestions around the Cape of Good Hope that delayed the voyages of those vessels even longer, So remember how I said it was 2 to 3 weeks additional travel time? Now, because of the congestions, this was even longer, and the European converters needed to restock since their shipments were being delayed. So they started to buy more cargoes locally, and so European prices went up, and Turkish buyers started to buy more European cargoes as well to circumvent the issues that the diversions were causing. And this was particularly hard for South Korean producers exporting to Turkey, as Turkey is a very big outlet for them because South Korean cargoes are duty free in Turkey. At the same time, Asia Pacific producers were also unable to take advantage of the higher prices in Europe, despite having higher netbacks because of the congestions that were taking place around the Cape of Good Hope. And what we are starting to see now is that the freight rates from Asia to Turkey and Europe is starting to ease, but those from the Middle East are staying firm. So between Jan and Feb, we saw Northeast Asian producers pay around $100 per ton, a very steep premium over the Middle East counterparts in order to export to Europe and Turkey. But I think rates have started to ease, and this is a mixture of what's happening in the Red Sea, where Asian vessels are being allowed to pass through, and also because at those levels, it's simply not sustainable for the Asia-based sellers to continue taking these routes. So there were some corrections in the prices to make it more sustainable for Asian sellers to continue shipping to Europe and Turkey. And what we are seeing, however, is that the freight rates from the Middle East to the West remains firm, and this could prove to be a challenge for Middle East producers. So what are they doing about this? Well, if we focus on Saudi Arabia, the producers are now reallocating exports because of these issues. So essentially what's happening is the West Coast producers will focus on shipping to Europe, while the East Coast producers will export to Asia. On the East Coast, we did not really see freight rates rise from the Middle East to Asia on the back of the Red Sea tensions, as these sailings and these voyages were not as badly affected. So it makes more sense for the East Coast producers to focus on Asia. As for the West Coast producers, while vessels cannot pass through the Bab al-Mandab Strait, the Suez Canal is still open. And what's happening is shipping lines are allowing smaller sized vessels to pass through the Suez Canal. But these vessels can only sail down until the port of Jeddah. So they do not venture beyond the port of Jeddah into the Bab al-Mandab Strait. And they just do shuttles back and forth between Europe and Jeddah. So because of this, the Saudi producers on the West Coast are focusing their exports to Europe. But this also comes with a challenge. As I've mentioned, these vessels are smaller, and there are not many of these vessels around. So the volumes that can be exported through the Suez Canal have fallen. And so to get around this, instead of shipping, or rather instead of just focusing on shipments through the Suez Canal, we have heard that some producers are also considering different options. One of them is even considering trucking all the way to Turkey. But from what we gather, this might be a bit too expensive. As initially, when the Red Sea attacks first started and Saudi producers were scrambling to find alternatives, one alternative that was put forth was trucking, and this was done as well by Saudi producers, but it's not a very sustainable alternative, as trucking costs are about $50 per ton from, let's say, Jeddah to Jubail, for instance, to go to Asia, or Jubail to Jeddah to go to Europe. So this would significantly weigh on costs. And producers did try to pass on these costs to buyers, which is why we saw prices globally start to firm a little bit at the start of the year. And with all that was happening in the Red Sea, we saw Middle East producers begin turnarounds before Ramadan. So this is actually quite normal for the Middle East. Most producers typically conduct their turnarounds before Ramadan. And then during Ramadan, when the operating hours are typically lower because of fasting, they will gradually increase the operating rates according to the operating hours as well. And as we can see as well, most of these turnarounds that we saw were on PP. And during this period, a lot of buyers noted that there was a sharp drop in copolymer supplies, particularly because of Baruja's shutdown. And so now most of these shutdowns are ending, and we are exiting this phase as most producers restart production. And of course, we cannot talk about freight without talking about the Panama Canal. So basically, what we saw here was that exports from the US to the west coast of South America, or WCSA, were falling quite sharply because of low water levels in the Panama Canal. But right now, we have started to see some improvements in this. So typically, for normal transits, there are about 36 vessels a day, but this fell very sharply to 18 in February. But now it's gone up to 24, with talks of increasing this even more as the weeks go by and water levels improve. And as an alternative to this, US exporters were also using rail to ship. But this Panama Canal situation actually proved to be an opportunity. As you can see, there's the vast ocean over here that is unblocked by any land mass or any canals that might have lower water levels. And this was a good opportunity for Chinese producers to actually step in and plug the gap. And we saw Chinese producers take advantage of this in both PP exports, which rose very sharply in the last quarter of last year on a year-on-year basis, and in PE exports as well. And from an export perspective, we do see this situation playing out very well in terms of freight. As you can see over here, the chart on the left represents the premiums that the Middle East Gulf producers are paying over Northeast Asian producers to export to the west coast of South America. And if we look at that from February of 2023 to January of this year, the premiums were very sharp, being at least $40 per ton that the Middle East had to pay in order to export to Latin America. And similarly, when we do a net forward comparison using the Argus assessed FOB PP raffia prices out of China, we can see that the Chinese net forwards actually beat the WCSA index that we also assess. So the naturally Latin American buyers favored Chinese and even South Korean cargoes over Middle East cargoes, and China is really developing a market here with the new PP capacities that are coming online. Yep. And with that, we have come to the end of the presentation. I would just like to share that, you can navigate the choppy polyolefin waters with Argus through our weekly reports, outlooks, and bespoke consulting and analytics service. Thank you very much.
Thank you, Matthew. Thank you so much. Let me introduce our next presenter for this morning's session. She is a market analyst who has been covering the Northeast Asian vinyl and Chinese polypropylene markets and handling pricing and data analysis. She was part of the team that launched PVC FOB China prices in 2022 and BCM CFR Northeast Asia prices in 2023. Prior to joining Argus in 2022, she was working with Honest Shancheng, which a domestic Chinese trading company, in a team responsible for trading, PP hedging, imports and exports. Our next presenter will speak on the Asia Pacific PVC and China PP markets. And with that, let me welcome Ms. Rita. Ms. Rita?
Hi, please let me share my screen first. So should be some technical problem of this. Give me 1 sec, sorry. Sorry for your patience. Hi, I'm Marita from Argus Shanghai. It's my honor to be here and share my views on opportunities and challenges for PP and PVC in Northeast Asia. Here's the agenda for my presentation. My presentation will be divided into 3 parts. First one will be focusing on Asia Pacific PVC by regions, starting from Northeast Asia, the key supply region in Asia Pacific. Then we will talk about the demand in India and Vietnam, who is the main driver in their regions respectively. The second section will be the challenges for oversupply Chinese PP. At the end, I will draw the conclusions for PVC and PP. So let's take a close look at the Northeast Asia PVC. These are charts to show the imports and exports in Northeast Asia over past 3 years. We are seeing that exports from these 4 regions outnumber their imports over past 3 years, especially Chinese mainland, who exported 1.7 million ton PVC in 2021. Then it increased to 2.27 million ton in 2023 with a steady increase. And China's Taiwan ranked the second, followed by Japan and South Korea. For imports, Chinese mainland has considerable and regular PVC imports, but it has been decreasing year on year with a slow rate. So that's why I use SPVC prices to demonstrate the history and margins in Northeast Asia. So as we all know that Chinese mainland benefited a lot of becoming the first one who had the pandemic under control. So many export orders flew into Chinese mainland since second half of 2020. And in 2021, large arbitrage window in first quarter and energy intensity in third quarter supported prices to surge. But in 2021, strict pandemic control has suppressed the PVC prices until when control eased and helped the PVC prices started to recover. Then prices in 2023 and afterwards will remain quite flat because of the poor real estate performance. It has dampened the PVC prices. Below lines are showing different cash margins based on different feedstocks without chlorine values. Lower PVC prices have squeezed the margins over different feedstocks. VCM-based is the only one who's making money, benefited from abundant supply in first quarter 2024. And margins at ethylene-based route were at a break-even point because of recent rising ethylene costs, while EDC-based were in negative margins for tight supply coming out from North America and the Middle East. So Chinese mainland is the top supplier, as we showed in the previous slide. They exported a lot because of its big capacities. It has accounted for 84% of total Northeast Asia capacities, as the left chart shows. And the right chart is showing the operating rates at PVC plants in Chinese mainland. And we can see that normally late first quarter, second quarter, as well as the early third quarter is the heavy turnaround season for PVC plants. So that's we can evaluate the impact of the supply coming out for Northeast Asia. And it can be seasonally support the PVC prices. Chinese mainland not only leads PVC capacities over past years, and it also leads PVC capacity expansions in the coming years. over the past years, we see a very slow capacity growth as Northeast Asia. 2021, the total capacity in Northeast Asia was approximately 30 million tons, but it will increase with a slow rate to an estimated number of 35 million tons in 2025. And China is the only one who has PVC expansions, while other regions remain unchanged. The table at right side are showing very detailed suspension list. As we can see that a total of 2.4 million tons PVC will be added in the coming 2 years, and the majority of them are ethylene-based. With these expansions, the total capacity in 2025 will reach to approximately 29.7 million tons. And ethylene dominates the expansions in the coming 2 years with an increased percentage of 29% in 2025 from 2023-24. So because of oversupply PVC and slow domestic demand, Chinese mainland need to export more to ease their inventory pressures. The total PVC exports from Chinese mainland increased by 15% to 2.27 million tons, with a very great accompanied with a large increase exports to South Asia. To be specifically, India has absorbed a lot of PVC from Chinese mainland. So Argus introduced the suspension PVC FOB China prices for both carbon-based and ethylene-based to monitor the arbitrage window for both routes. And we can see that the increase of FOB prices in the 2 red circles were supported by Indians restocking on seasonal demand. So India does not account for a large percentage of PVC exports to India, but also 48% of Northeast Asian cargoes went to India in 2023. Restocking from Indian buyers have been so strong in 2023 because of healthy agricultural demand. Let's take a look at PVC in India. As the left chart shows, it is the Indian imports by region during over past 3 years that we are noticing that Indians suspension PVC imports have been expanding over past 3 years, reaching 2.48 million tons in 2023, who has an increase of 80% compared with previous year. And as we can see that the blue charts showing Northeast Asia plays a very key role in PVC imports into India. From the right chart, we are seeing the Indian PVC imports from Northeast Asia with breakdowns for by regions. We can see that in 2021, Japan is the top supplier of the PVC imports into India because of the zero import duty. But after 2022, things has changed as Chinese mainland surpassed Japan to become top supplier with sharp increase during 2022 to 2023 because of lower prices. Overall PVC prices trend is quite similar as the CFR Chinese mainland. Downward trend of PVC prices were caused by gloomy economic situation and inflation after 2021. And more supply pressures coming out from Northeast Asia is another factor contribute to this. Currently, we are seeing prices remain quite flat because of cautious sentiment as Chinese mainland is still slowly recovering to pre-pandemic level. And there is elections in May, so we are expecting something changes at the demand in India. So PVC consumption in India was expected to increase to 4 to 4.2 million tons in 2020. So we must wonder, where did these suspension PVC imports go? According to the industry estimate, 75% of the suspension PVC will apply in PVC pipes and fittings, with 50% of the use in constructions and infrastructure, and another 45% of them are for agricultural sector. These are key projects that has implemented to boost the PVC demand in 2023. These projects was brought to provide better living conditions in India. PMKY, as we showed in the top, at the top, is the key project that drove agricultural demand strong in 2023. And another two projects are mostly completed, and some will continue towards 2024. So during the next 5 years, we are still witness a sustainable growth based on Argus Consulting Service and Oxford Economics. It has the best performance compared with other countries in South Asia, and it has the best performance compared with other countries in South Asia. Growing population and urbanization will become the incentive to stimulate demand in India. According to the data published by United Nations, more than 40% of population will be urban India. So with growing urbanization and the population, Indian government plans to make more investments in infrastructure and real estate. Some important projects, as the left table showed, are to be commissioned in 2024. So I would like to say demand for PVC pipe and the profiles are anticipated to stay firm with these projects implemented. But here are some hurdles for PVC imports into India. First one is the BIS and the quantity restrictions. BIS is the standard that both import products and domestic products need to follow. And the BIS on PVC imports will take effect after 180 days after February 26. Producers from South Korea and Taiwan have already got their BIS certificates for PVC products, while Chinese mainland are still in the process. Another barrier for PVC exports going forward into India is higher self-sufficiency with growing PVC expansions. There are a total of at least 3.5 million ton PVC caps online during 2025 to 2026, while China's mainly started from the end of 2024. And it seems more PVC plants, but the total additional capacities are less than India's. So besides India, Vietnam also plays an important role in Southeast Asia. These are three charts to show imports and exports at major Southeast Asian countries over the past 3 years. As we can see, Vietnam is the largest PVC importer in Southeast Asia, and the imports has increased from 2021's 500 KT to 2023 626 KT. So you must wonder, where did these imports mainly come from? It mainly comes from Northeast Asia, other Southeast Asia countries, and the US. From the left chart, we are seeing PVC imports by regions, that we notice a decreased percentage of Northeast Asian cargoes from 2021's 80% to 2023's 60%. Meanwhile, Southeast Asia and the US have been expanding their market share in Vietnam. The right chart is PVC, Vietnam PVC imports from Northeast Asia over past 3 years. The shrinkage of PVC exports from Northeast Asia, mainly led by less PVC exports from Chinese mainland and Japan. I would like to speak a little bit on the reasons that contribute to this. First one is the US producer have been offering competitive to Southeast Asia to ease their inventory pressure. Second one is the enforcement of UFLPA took effective on May 2022, made Vietnamese manufacturers find substitute for PVC from China's Xinjiang. But generally speaking, Vietnam holds a prosperous GDP growth in the coming years, with growing exports and rising manufacturers and tourism. This will spur more investments in infrastructure and in constructions. So it can also be incentives to PVC demand in the coming years. So that's pretty much for PVC market. As we know, China's not only face oversupply of PVC, but also see oversupply of PP. So what's the challenges in the coming years for China's PP? First, let's look at the expansions. We are seeing a lot of expansions over past years, and it will continue in the coming 2 and 3 years. There are around 8 million ton PP to start up in 2024. Might be the peaking period for PP expansions, but some projects have been delayed because of margin concerns. So 2025 is likely be the peak period as well. So capacity have grown faster than domestic demand, which led to a self-sufficiency of 92% in 2022. Then it will continue to increase with slow rate. The estimated number in 2024 is 95%, mainly caused by large expansions. And the Chinese government targets at around 5% of GDP growth in 2024. And the PP consumption is projected to increase by 5.1% in 2024. China's PP prices remain the lowest, as the right chart shows. That's the regional key PP, raffia PP, home polymer prices. And we are seeing that winter storm in US happened in fourth quarter 2020, and the continuity into first quarter 2021 has pushed China to become one of major exporters afterwards. And China has been regularly exporting PP each month since then. The average PP exports over past 3 years were at 1.3 million tons. We are seeing a slightly drop in 2022 with a number of 1.27 million tons because of the normalized supply outside China. And another key reason for this is the freight rates remained comparatively high level compared with pre-pandemic level, although it dropped from the peak already. And the last key factor to this is the pandemic controls in 2022 also slowed the exports process from Chinese mainland. And we can see from the chart, Southeast Asia with a very dark blue column still show remain the largest importer of PP from Chinese mainland, benefiting from import duty cuts and geographical location. So China sees the chance to prompt the PP FOB China prices, as PP raffia leads the largest consumption of homo grade. So we introduced PP raffia FOB China first in May 2021. Then we realized a steady exports at PP block polymer. So we introduced the PP copolymer prices since September 2023. So for PP exports from Chinese mainland, there are still many challenges for this, mainly because of a higher self-sufficiency rate with domestic expansions outside China, or some policies to reduce dependence of import cargoes in other regions. The competition was so fierce in both domestic market and overseas market. So we must wonder who's making money in China now. These are cash margins comparisons for different from different feedstocks to olefins. We can see that ethane is the cheapest feedstock, as Fadil mentioned, and it has the highest cracker production margin. And meanwhile, propane and the naphtha are in negative margins because of uncertainties in naphtha. Propane, because of uncertainties of these two feedstock prices. Secondly, oversupply of olefin has led to lower olefin prices. And another key reason for this is the downstream demand, such as PP, PE, MEG, they are not strong enough to support olefin prices. So naphtha cracker and the propane cracker have been consistently in negative zone. And we also noticed that PDH is facing the same situation where oversupply of propylene and weak PP demand also weighing down on PDH margins. Negative margins and the great expansions also suppress the operating rates at PP plants. The average annual PP operating rates fell to 78% in 2023 from 2022's 81%. We are expecting continuous lower operating rates at PP plants for large expansions in the future. As the right chart shows, normally we can see that the second quarter is the heavy turnaround season, which can potentially support the PP prices during this time. That's almost the end of today's sharing. So I would like to draw some concluding thoughts on these two products. For both PVC and PP, we can see that seasonal demand and a turnaround season will support PP and PVC prices in the short term. But as we all know that these two products in Chinese mainland are oversupplied, and there are still some expansions in the coming years. But luckily, India's consumption is expected to grow by around 8 to 10% per year before 2025. So with continued construction activities, and India is likely to rely on imports. For PVC and PP separately, PVC, the key factor to PVC is the BIS certificates in the short term and expansions in the long term. And the major factor to PP is PDH-based PP plants. The operating rates and expansions in the near term and the long term could also impact PP prices and outlooks, as they are playing a kind of role of readjustment in PP market. That's all for today's sharing. Thanks for your time and listening.
Thank you, Ms. Rita. Thank you so much. With that, let's move on to our next presenter for this morning. Our next presenter is a senior reporter and covers the news and analysis of petrochemicals in Argus with a focus on polymers. She is experienced in the tracking and analysis of oil and gas prices, petrochemical prices, as well as market trends. Before joining Argus, she was a pricing advisor at Petron, where she was responsible for determining pricing structures and strategies for oil products, including fuels, LPG, aviation fuel, and lubricants. She also provided insights and supported Petron's key business and investment decisions. In addition, She had also spent a year working in a Shell refinery, making her well versed in refinery operations. She holds a bachelor's degree in chemical engineering from the Petronas University of Technology with a specialization in oil and gas studies. Our next presenter will present an overview of the Southeast Asia polyolefins market. Please welcome Ms. Yi Ying Ang. Ms. Yi? Ms. Yi?
Yeah, thank you so much, Francis. And hold on, I will share the screen.
Yes.
Okay, can you guys see my screen?
Yeah, all good.
Okay, thank you very much, Francis. Hi everyone, my name is Ying, and I cover the Southeast Asia polymers market. So I will give you a quick overview on the Southeast Asia PE and PP markets, and it's a pleasure to be here today and sharing the information with you guys. So we'll start with a bit of Asia price trends. Yeah, so today basically I think if we look at this chart, there's a series of supply shocks that actually drive up the consumption. They drive up the prices in the past few years. Just give me a few seconds. Yeah. So as you can see from this chart, there are supply shocks and shipping issues that have pushed up PE and PP prices over the past few years during the pandemic. Prices actually returned to the pre-pandemic level last year mainly because of new capacity and also weaker demand. Even as Southeast Asia polyethylene and polypropylene prices now remain $150 to $250 above pre-pandemic, you can see that naphtha, which is the black line, it's still $400 above pre-pandemic level, which has resulted in very poor margins among the producers, especially the producers in Southeast Asia who are operating based on naphtha feedstock. So in the long run, we expect that the short-term supply shocks will eventually lead to short-term recovery in the market, which is like what we saw earlier this year when the Indonesia enforcement of the import mandates have actually driven up prices of Southeast Asia to be the highest prices in Asia. But prices are likely to stay depressed for a longer time because of the new capacity expansions that have been added in the past few years. And in the long term, producers may consider, especially for producers in this region, may consider consolidation and also idling some plants in the region. And I think producers in this region are already they are already more flexible in shutting down their plants whenever their margins are eroding, and also to manage their inventory. So if you can see from this chart, this is just a chart to show you the LLDP prices in the key markets. And LLDP prices in global markets, they are actually converging, if you can see, because of the overcapacity pressure. US LLDP prices used to be $400 to $500 above China prices back in 2021, 2022, when there's a US winter storm. But it has now even fallen to below below Chinese prices last year, which reopened up the arbitrage for them to sell into Asia. But as you can see, with the dark blue line, US Asia prices begin to rise again, and we are seeing less limited arbitrage for them to export to Southeast Asia. And also Southeast Asia prices, if you can see here, prices are the highest in Asia, and that's mainly driven by the initial announcement during December that Indonesia is going to is going to enforce the import quota, which didn't materialize in the end. And this is a chart to show you PP prices. Similarly, just like other markets, PP prices in global markets are converging because of severe overcapacity, and it's even more, and you can see prices coming very close to each other. And we saw Indian PP prices $150, $250 above China in 2022, but it has now normalized and come back to the level where the rest of the Asia prices are. And also arbitrage has begun to reopen for China PP supply to Southeast Asia, if you can see. So I think just now I mentioned that Southeast Asia prices are currently the highest, which is mainly driven by the earlier import quota announcement by Indonesia. So now it's keeping a spread of $20 to $30 above China PP FOB prices, which we assess in August. In order to manage the inventories, we have seen producers worldwide, whether it's in India, in China, and Southeast Asia, producers are shutting down their plants for maintenance during this time to manage their inventories. And as for Southeast Asia, the region that I covered, very likely producers are going to do that more often if they see there's anything that's squeezing, as in margins are very, very bad for them. If you can see on the right side is actually a table of the maintenance table that we publish on a weekly basis. And this is actually not the full table yet. It's a long list that we have for the current maintenance. And even with that, China PP prices are still the lowest in the world because of the capacity expansions that we have seen in the past few years. So moving on, let's look at how much new capacities can we expect. For PE itself, capacity expansions, we are expecting it to slow down in 2024. But let's just bear in mind that there are a few US producers who have started up their plants in the past few years, but they might not have ramped up their plant to full operations yet. And so those supplies are likely to come into the market later in 2024, 2025, when their plants stabilize. But for this year itself, we are expecting 5.4 million tons of new PE capacity to be added this year, which we already saw 5.5 million tons of new capacity for PE added last year. So globally, there will be 5.4 million, and 4.2 out of these 5.4 million are actually delayed from last year. In the short term, China would add around 5 million tons of new polyethylene capacity in 2024, 2025. So, but in the long term, at least in the span of 7 years from 2020, China is expected to add 20 million tons of new polyethylene capacity, of which 60% of this plant capacity has actually started out. So, if you can see on the table, the plants highlighted in yellow are the ones that have been delayed from last year to this year. And I think we will see even more challenges for these new producers to actually start their plant because of the poor margins and environment right now. It's just not feasible for them to start their plants. And this is just a chart on global PP capacity share in 2023. As you can see, China dominates global PP capacity. So just for your information, Northeast Asia, 51%, it consists of plants in Japan, in Korea, and in Taiwan as well. But of course, China still holds the largest portion of the PP plants in the world. And for 2024, we're expected to see 12 million tons of new PP capacity in 2024. 6.4 million have been added last year, but it will be quite challenging for these 12 million tons to start up this year because of the current margins environment. In the short term, China would add around 50 million tons of new PP capacity in 2024, 2025. But in the long term, China is expected to add 36 million tons of new PP capacity. in the span of 7 years since 2020. Of which 15 million tons or 40% of this plant capacity has started up. So same as the previous table, the ones highlighted in yellow here are the plants that have actually that was supposed to start up last year but was delayed. And we are expecting commercial operations to happen this year. But similarly, we are expecting some of the plants that are supposed to start up this year to be delayed to last year. Historically, we are seeing 20 to 30% delay in the plant capacities in China. So 20 to 30% of the plant capacities that are supposed to start up in China this year will likely be delayed to the following year. And moving on towards to Southeast Asia, we are expecting regional trades to stay, which means there will be more trades between the region. Southeast Asia producers will increase and target regional converters. They will sell within their domestic market or regional markets just because of for better netbacks. Of course, domestic prices usually gives you a better netback because you also don't have to there's an advantage in terms of freight and also logistics costs. So just to give you an idea, we have a couple of plants that have started up recently, which is the Thailand's HMC Polymers 250,000 pp plant, and also Pengerang, Malaysia's Perovchem. But yes, commercial operations of Malaysia's Perovchem is actually facing a delay, and we are also hearing that the plant operations have not been very smooth, and very likely in March and April there won't be much volume because they are also going for a short maintenance. For Longsong Petrochemical, recently we heard a force majeure announcement in late February, and ever since then the downstream units have also been shut temporarily, and now we're expecting maybe a couple of months of shutdown from the producer at the moment. So maybe there won't be much volume in the second quarter, but we already anticipated that the producer is actually targeting commercial operations in the second half of 2024. So yeah, the supply won't be so much coming from this producer at the moment. JJ Summit, they are still trying they have a new 250,000 PE plant, HDPE PE plant, where they can also produce the metallocene LDPE grade, and they are still conducting the trial runs on the HDPE unit and also targeting commercial operations in second half. So overall, Southeast Asia is expected to see 2 million tons of new polyethylene capacity and 1.3 million tons of new PP capacity. Yeah, so very likely there will be limited new supply coming in the second quarter. But in the longer term, let's look at Indonesia. There are a lot of projects, at least there are 5 projects which I've listed here, which have been delayed because of the current situation and other reasons. But at least for now, we heard that Lotte Indonesia is expected to achieve commercial operations of the new PP unit in 2025, in early 2025. Very quickly, just to show you some charts on Chinese trades. So this is a chart of China PE polyethylene import share. And as you can see, US producers have been increasing exports to China year on year ever since the trade war tariff is lifted in 2020. So in the future, when US producers more US capacities come online, they are very likely to increase exports, PE exports, to not just China, but to the rest of Asia, to India, to Southeast Asia in the next few years when their plants achieve commercial operations. Because obviously Asia is still the driver for consumption in this part of the world. And yeah, so that's why they will be targeting South Asia for more exports in the next few years. And Middle East and Southeast Asia polyethylene export share to China fell by 18% and 6% respectively in 2023, mostly because of lower netbacks into China and also higher China's self-sufficiency. So very quickly, Rita has shared about PP just now. I'm just sharing on China's PE self-sufficiency. Right now, it's at 68%. China polyethylene consumption actually rose by 7% to reach 40 million tons in 2023. But production or output actually rose by 11% to reach 27 million. But because of the poor margin environment and demand has not been great, I would say, Chinese producers were actually forced to reduce operating rates to 85% in the past few years, from around 95% in the past pre-pandemic, before the massive addition of new capacities. So right now, China self-sufficiency is at 68%, but because there are not many major expansion in the next 2 years, so it will stay at this rate, and China will continue to import polyethylene in the next few years. But again, when it comes to 2026, we will see a lot of new cracker projects and also downstream projects are likely to start up in China, aiming to start up in 2026. Jumping into PP. So if you can see here, the left chart shows the export, China PP export in 2022, and the middle chart shows China PP export in 2023. Southeast Asia takes up 38% of China PP exports in last year, which has gone up by 11% compared with 2022 performance. And so China producers will definitely continue to target Southeast Asia for their PP exports. And Southeast Asia, South Asia, and South America take up 71% of China PP exports at the moment. China expected to add 36 million in the span of 7 years from 2020. And if you can see the chart on the most right, China PP exports have been rising year on year, and there's actually more room for the exports to grow. And how China managed to export PP into Southeast Asia, it is also mainly driven by the lower freight rates. So polymer freight rates, as you can see on the right chart, from Shanghai to Port Klang, it used to be around $140 in August 2022, but it has gone down and reached a stable rates of around $20 to $30 or even lower than $20 to Southeast Asia, which have made it easier for the Chinese PP producers to export their materials to this region. And in terms of lead time delivery, it's also easier for them to manage. So now let's look at Southeast Asia trades a bit on supply and demand. The chart on the left shows you Southeast Asia import share. And if you can see, if Asia share combined all together, it is actually closing up the gap with the share that the Southeast Asia converters import from the Middle East. So, but in 2023, let's just focus on 2023. North America polyethylene exports increased by 7% in 2023, which is replacing Middle East export share. So also in the beginning of this year, we see a heavy turnaround schedule in the Middle East, which have resulted to lesser volume coming to the Southeast Asia market, but that is being replaced by the supply coming from the regional producers. So if you see the chart on the right, those are the 7 top exporters of polyethylene into Southeast Asia. And of course, US and Malaysia are showing growth in 2023 compared with all other countries, while Saudi Arabia's volume to Southeast Asia are actually reducing. As for PP, on the chart on the left, you saw a very strong diverging line between the purple line and also the black line, which shows the Asia export share into Southeast Asia and also the Middle East export share. So Middle East exports have dropped by more than 10% in 2023 against 2020. Northeast Asia PP exports are rising rapidly, especially after the massive expansion of new capacity in South Korea and also in China. So 2019, 2020, we saw very a heavy expansion in South Korea and China, and ever since that, China, Northeast Asia trades have been increasing to this region. Malaysia, China, and Vietnam are among the countries who recorded growth in 2023, which means these countries are selling more and more. They are focusing more and more on selling into Southeast Asia compared with other countries. Very quickly, just to show you the supply and demand balance in Southeast Asia. As you can see, let's just focus on the gray color bar, which shows the supply deficit. So for most of the other countries like Malaysia, Philippines, Singapore, and Thailand, they are net exporters in this region. Of course, and Indonesia and Vietnam, many producers are targeting Indonesia and Vietnam for export because these are the countries where they are still importing. They are still importing from other countries, but Vietnam polyethylene supply deficit is expected to be reduced further and further because after the expansion by Longsong Petrochemical, after they come online, where they're expected to add 1 million tons of new polyethylene capacity this year, by the end of this year, which have been challenging for the market. So just to show you a bit on the PMI and also the annual GDP growth rates for Malaysia and Indonesia for comparison, and also for China. Near-term demand, what we saw right now covering the Southeast Asian market is actually quite weak this year. And I think as Mr. Fadil mentioned earlier, that inflation is also very high in Malaysia, and its PMI have stayed in the contraction mode since September 2022 due to high production costs and inflation, and also weaker local and also export orders. So near-term demand looks a bit weak at the moment, but long-term growth is actually projected. It's projected to be modest, and also China's economic growth this year, it's targeted to be about 5%, which is down from 5.2% from 2023 because of slow consumption and local government debt. So I think, speaking to the Chinese participants and also RITA itself, I think we have heard that after the Lunar New Year, some of the converters or trading firms who have actually did market survey mentioned that the demand for finished products is actually weaker in the first month or from January to February this year compared with last year, which participants are actually closely watching the development in China before purchasing any resins. So here are some concluding thoughts. This is the end of my presentation. Supply shocks are expected to boost polyethylene, poly-PP prices in the short term, but huge price recovery is very less likely. Southeast Asia producers in the longer term, they may consider consolidation and idling some plants, and they for the time being, I think producers are considering shutting down their plants to manage inventories should their margins get eroded or demand is turning weaker. So 5.4 new polyethylene and 12.3 new PP capacities are expected in 2023. China PP exports to Southeast Asia are definitely going to continue and are expected to rise as new capacities come online. Southeast Asia demand is likely to stay modest in 2024, which are putting pressure on prices right now, but a delay in startup of new plants and a heavy maintenance schedule in Southeast Asia in April and May could support polyethylene and polypropylene prices. But let's not forget that this region itself, we are also facing an influx of supply coming for PP, especially coming from China and also Middle East. Producers are expected to wrap up their maintenance by the end of this month, and very likely we might see more Middle East supplies coming into this region. Chinese investment shifting to Southeast Asia could eventually shift some resin consumption to Southeast Asia gradually, but that's taking place on a gradual basis. And of course, we have already seen a few trade protectionism measures. The key being the Indonesian import mandate that was announced last year in December, that all importers are expected to apply for an import quota before they can import materials from other countries. That have raised a lot of concerns because Indonesia imports 40% of their PE and also 60% of their PP, which make it very difficult for the local converters because of the short notice and the process are also unclear. So eventually, the plastic associations definitely they have actually gone against the implementation of this, and the mandate has been temporarily dropped for the time being for all the key polyethylene and polypropylene imports in Indonesia. And that's actually a good news because that means Indonesia will come back to import and balance out supply in the region. But I think right now the Indonesian converters and the distributors are actually holding high inventories because of the earlier stock build, and very likely they will mostly come back and buy resins for May shipment itself, which is in end April itself, which means these prices that could put pressure on the regional prices. Yeah. So so very likely we will see more trade protectionism measures because it will be used to protect the local production, domestic production, because of all these high competition and eroding margins. And very quickly, I just want to show you in for Argus in Southeast Asia, these are what we have done. We have started with 5 assessments on Southeast Asia, but we have since grown the coverage to include Vietnam and Indonesia, and we have also launched the duty-free prices, and also the prices of many other grades. And yeah, so if you have any questions, feel free to reach out to me. And yeah, thank you so much for having me. That's the end of my presentation.
Thank you, Missy. Thank you so much. Okay, I shall now introduce our final presenter for this morning's session. He is a market reporter who has been covering the recycled polymers markets in Southeast Asia since August 2022 and helped launch the Argus Recycled Polymer Southeast Asia coverage in March 2023. He has the benefit of actively engaging and speaking to some of the largest recycled polymer players in the region on a weekly basis. He is passionate about covering this nascent industry and enjoys learning about this developing sector and growing alongside it. Our next presenter will speak on the recycled polymers market. Please welcome Mr. Akash Ravindran. Akash?
Thank you very much for your introduction, Mr. Francis. Let me just share my screen. Can I just get a thumbs up that you can see it? Okay.
Yeah, all good, all good, all good.
Okay, great. All right. So yes, thank you again for the introduction, Mr. Francis. As he said, my name is Akash Ravindran. I'm a market reporter covering the recycled polymers market in Southeast Asia. So I would like to start by discussing the two sides of demand to recycled polymers, and this can be split into cost-driven and sustainability-driven. So if I can direct your attention towards the bottom of the arrow, we can see that the cost-driven side is much more for the lower grades of polyolefins, such as your recycled PE and recycled PP black. And these are typically used for applications such as pipes, durable goods, construction, manufacturing, and generally seen as a cheaper alternative to virgin polymers, as well, these sectors don't have much regulation on recycled content usage. And typically when virgin prices are low, there are more opportunities for recyclers to sell these, but this does come with its own set of problems, which I'll discuss later. Now, if we could look towards the top side of the arrow, I would like to show you the sustainability target driven side. And this is more for grades such as recycled PET, which we see in F&B applications, or recycled HDPE for personal care applications, and increasingly more recycled PP for automotive applications as the EV industry is growing. And these days we're seeing that this demand is getting considerably higher, And the sustainability target driven side of the recycled polymers market is generally priced at a premium to virgin polymers. Now, in Europe, the sustainability side is higher. So if we break it down by region, in Europe, we see more on the sustainability driven side. And this is again focusing on rPET, which is packaging and much less cost driven. But interestingly, to look at polyolefins in Europe, the cost driven side is higher as demand comes from these cost saving markets for the lower grades of recycled polyolefins and secondary applications, like I mentioned before. Now, to look towards Asia, this is somewhat different. So if you look towards the pie chart on the right, you'll see that the section marked out in blue is the cost-driven side, which is markedly different to what we see in Europe. And the reason for this is that there are considerably fewer regulations that have come into place. So both recycled PET and recycled polyolefins tend to be more on the cost-driven side. And one of the main reasons for this is that global brand owners are typically looking to cut costs, and domestic brands, say in Indonesia, Thailand, Malaysia, Vietnam, where we see the largest markets, they're less willing to pay a premium for high quality recycled material. Now, moving on to cost-driven demand. We can look at this graph here. We can see that the recycled polyolefin cost-driven side has been less and less profitable for recyclers. Now, the recycled prices for these grades are very closely linked to virgin polymer prices. And whenever there's a drop in virgin polymers, we'll see that there's a almost commensurate drop with recycled prices. And this is, well, this has been true very much for the larger part of last year. There's been a weaker demand in manufacturing, construction, and industrial sectors. And looking at the graph, if we see around February this year, there has been an increase in prices. But like I mentioned, the reductions in virgin polymer prices last year have actually put significant pressure on the lower grades of recycled polyolefin prices. And so whenever virgin prices drop, like I said, we will see a drop in recycled prices. So in order to sell these lower grades of recycled polyolefins, recyclers must maintain a discount to virgin prices. And this is also true for recycled LD/LLDPE grades. And although we see, or I mentioned that there is a strong link between recycled and virgin prices in this case, again, if you look towards February, we can see that when virgin prices increased, recycled prices have not necessarily increased in line with this, showing that demand is really quite volatile. And in order for this to change, regulation needs to come into place. And what this means is that recyclers will have squeezed margins. And primarily in the 2 years post-COVID, we can see that recycled grades haven't been able to make much of a profit. So moving on, another concern is the reduced demand for these lower grades. So looking at the slide, we can see the Purchasing Managers Index for the Eurozone construction and manufacturing sectors. And we can see that since April 2022, it has actually been in a contraction. And this really shows that demand has been slowing down for both recycled and virgin materials in these sectors. And although this illustrates Europe, to build off of what Fadil spoke earlier, I believe he showed the graph on China's year-on-year decline in real estate investment. I mean, this is another indicator that this is actually a global issue for recycled polyolefin recyclers. And if you were to look at China's manufacturing and construction PMIs, you would see a contraction as well. Now, another concern is the growing capacities of virgin polyolefins, which Ying touched upon previously. And what we're seeing is that these capacity growths are actually outpacing demand. And one of the reasons for this is typically, well, higher crude oil prices, lower operating rates at plants, and we'll see that we've seen that growth does remain poor consumers globally and in China have been fairly conservative in the time post-COVID, and inflation, although it seems to be getting better now in the US, and globally as well, has really affected purchasing power. So that's it for cost-driven. But to move on to the sustainability-driven side. So what this graph reflects essentially is the premium that recycled HDP, natural, or white has to their counterparts on the virgin side. And what we can see here is that these grades, these higher grades used for your personal care applications or automotive applications, for example, these are not constrained by the same market factors that cost-driven demand grades are, or even virgin polymers are. So essentially, these grades do command a premium over virgin prices, as one, buyers need them, and two, they're actively looking for them. And because the cost of sourcing this high quality material, which is limited, owing to varying sorting and collection infrastructures across countries, this leads to higher production costs, and then meeting particular customer specifications, all adds to your costs, and this will inevitably lead to a premium. But that being said, a positive for regions such as Southeast Asia, if I can draw your attention to this graph here, we can actually see the difference in price that these similar grades have between, well, we have our US Midwest assessment, Northwest Europe assessment, and our Indonesian domestic price assessment. And the advantage that regions like Southeast Asia or even Turkey or North Africa, if you were to look at it, is that production costs are relatively lower than in Europe and the US, which means that there is actually more of an opportunity for interregional trading, to places like Europe and the US. And this is buoyed by the emergence of plastic exchanges and trading house, which deal with recycled material. So yeah, so there are arbitrage opportunities into this region. And one of the things we are seeing is that there are increasingly more increased offers from European buyers, to European buyers from Southeast Asian recyclers, and Europe being the region where legislation and regulation is much more developed than anywhere else globally. So, pardon me. So the regulation that does exist currently in Europe, that being said, is tailored more towards the recycled PET market. One, there are fewer applications. Two, there are fewer grades, so it's slightly easier to construct and build upon. But on the recycled PE and recycled PP side, the sustainability target-driven side is primarily being helmed by voluntary pledges from brands to use recycled content. So your FMCGs, Coca-Cola, Danone, Unilever, say they've made commitments to use X amount of recycled content or to include a certain percentage of recycled content in the products. I think across the board, we can see the date is 2025, which is a positive. The sentiment is that currently we are not on track to meet these targets, but that's not to say that things are not moving in the right direction. So to take a long-term view, one of the interesting things we've seen is that throughout last year and early this year, the weak economic environment that we have globally and particularly in the US has actually been a positive for the recycling industry, because it's a good time to consolidate, especially from the side of large petrochemical producers. And you can see here on this graph that some of these producers have looked to produce a certain amount of recycled polymers by 2030 and have actually bought into the supply chain to build infrastructure to support this. I think, like I mentioned previously, by way of improving and developing collection and sorting infrastructure, which is one of the main barriers towards the development of the mechanical recycling industry. To look at Europe, I think the situation is perhaps somewhat different. the industry is a bit more established and the larger recyclers are sort of able to survive the challenging economic period, who, well, they have the financial backing to weather the storm. Now, moving on, this graph you can see here demonstrates the FMCG volumes from sales volumes from Q4 2022 to Q4 2023. And what we can really see from this is that major brand owners are really spearheading the development of the sustainability-driven demand side of things. Sales volumes from Q4 22 to Q2 3 23, excuse me, have really come under pressure because of high inflation. I think if you look towards the graph, you can see the sales volumes are all in a negative, and this really is because of high inflation, customers not having purchasing power, you know, less likely to look towards premium consumer good brands, which do include recycled content. So we saw that demand for recyclates really did take a hit. Give you a good example, deciding to buy a product that contains recycled material for a higher price when you have a cheaper option that maybe doesn't, not necessarily realistic. But if we look towards Q4 2023, with the exception of the two outliers, we can see that the sales volumes actually have been increasing. And if not for the two outliers, I think Q4 would actually be positive. It's not to say that this is a complete turnaround, but as you can see, the trend line shows, the dotted black line shows that the pressure is lifting. And what this really means is that these large global brand owners have seen increased revenue, which means there are more sales, which means that there's more plastic required for packaging, and a significant portion of this will be recycled material, and that portion will continue to grow as legislation comes in and the industry develops. So on the legislation side, Europe is really leading the way. But just to illustrate to you, I'm not going to go through everything on this slide because I'm conscious of time, but this is just to give you a brief overview of some of the legislation in Asia that does exist, by various EPR schemes, master plans, plastic roadmaps, just different forms of developing legislation that in a way that Asia is catching up towards the rest of the world. So, like I just mentioned, Europe is at the forefront of developing regulations, legislation and EPR schemes around the plastic recycling industry. There are actually many examples of this, but the one I would like to focus on is the one that you can see here in this graph, and it's the amendments that are being made to the EU waste shipment regulations. Now, what this means is this would effectively ban the export of plastic waste, or in this case, feedstock, to non-OECD countries. And from what we've seen, this is primarily going to affect Southeast Asia. So you're looking at your smaller recyclers in Indonesia, Thailand, Malaysia, Vietnam, who do source feedstock from Europe, who don't have their own collection infrastructure set up. These recyclers will be forced to seek alternatives, inevitably pay higher costs in the short term, and really see their margins squeezed. But what we're seeing is that in the long term, this will become increasingly less prevalent as collection and sorting infrastructures develop within the region, which is happening, but it is a matter of time. Yeah, so to look forward again, these are just some of the factors affecting the Asia Pacific recycling outlook. I think I've mentioned some of these before already. On your bullish side, you have your higher crude prices, the sustainability targets fast approaching in 2025, and the arbitrage opportunities. And then on the bear side, again, the weak economic environment, increase of virgin capacity growth globally, and well, I won't go through all of them, but yes, those are just some to name a few. And just to touch a bit on finally, So, like with legislation, Europe is really leading the way in the chemical recycling industry. Similarly, chemical recycling capacities in Asia have been slower than in Europe and the US develop, but that doesn't mean that it's not happening. And I think some of the challenges that are faced by the European chemical recycling industry, such as actually sourcing feedstock and labor costs, are actually, you know, not seen in the Southeast Asian side. So the challenges here, for example, okay, your informal waste collection sector, the issue is not with the amount of waste that you collect, it's actually just the consistency of the quality. But again, as the frameworks develop, this will only improve and get better. And yes, as these things improve and get better, partnerships and partnerships with chemical recycling solutions providers, and increasingly more we're seeing state-owned enterprises who are in Southeast Asia, such as IOCL, in South Asia, such as IOCL and Petronas, I believe, who are investing in chemical recycling, are really going to help alleviate some of these issues and help the Southeast Asian chemical recycling to develop. Probably what we're seeing faster than what's happening in Europe, even though it was a bit later to start. And yeah, that's the end of my presentation. Thank you very much.
Thanks, Akash. Thank you so much. Okay, we have finished all the presentations for this morning. Before we jump into the Q&A, I need to make this announcement. Yes, this one. Okay, ladies and gentlemen, what you see on the screen is the QR code to access free sample reports or to find out more about Argus Chemical Services. So, ladies and gentlemen who are interested to know more about Argus can quickly scan this QR code for even free sample reports. Okay? Okay, let's move on to the Q&A session. And before we start, the questions that our moderator, Mr. Alvin, will query the presenters this morning are the list of questions that was supplied by the attendees when you did your registration. I just want to say before Mr. Alvin does the Q&A, that some of the questions were actually covered in the presentations, and some of it's actually out of scope. So, Ms. Alvin, please only cover those questions with the name of the person, the presenter next to it. The other questions you can skip, Alvin, okay?
Okay, thank you, Francis.
Okay.
How are we with time, Francis?
Yeah, we actually
Supposed to end at 2:30. It's now already 2:18, 12:18, sorry.
yeah, 12:18. So never mind. You try to answer try to run through all the questions. But like I said, skip all those which are covered in presentations or out of scope or to be ignored, like Alvin.
Okay.
Okay, thanks, Alvin. Okay.
Okay, let's quickly start with Matt. Can the price of raw material be in currency other than US dollar?
So this is a very hot question. I think this, of course, de-dollarization was very hot last year. When we saw the US dollar appreciate very strongly, and we did see some instances where trade was being discussed in other currencies. I think one major discussion on this was between Saudi Arabia and China, where they were discussing the potential of selling oil in yuan. But will this happen in polymers? It's very difficult to say, but from what we've seen, India has already started allowing transactions to be done in the Indian rupee. And this could be a huge boost for the other South Asian countries like Bangladesh and Sri Lanka, because being able to trade in rupees means that they don't have to draw down on their US dollars. And in terms of exchange rates, also, the cost of purchasing the Indian rupees will be much lower than purchasing US dollars. So this is definitely a very welcomed idea in South Asia. But from enforcement perspective or logistical perspective, what we heard is that there needs to be time for these payment services to be implemented and accepted internationally. So, for example, with US dollars, we have SWIFT, and in India, they have their own system as well, which they are still in the process of trying to roll out. And the government is looking at this very closely. But whether it will happen or not, I do not seeing happening in like the next 1 or 2 years, but maybe beyond that. If the US dollar continues to stay very strong, we could see this potentially happen. And something like this could also happen in other regions as well, where there are close economic ties and very strong trade. So I'm very strongly hinting at Southeast Asia here, where it could also be possible down the road. Yeah.
All right, thank you, Matthew. The next question is to Yi Ying. When China becomes a net exporter of commodity plastics, how would the landscape of pricing be for the Southeast Asia region? China net exporter, I don't think it will come in the next probably 10, 15 years. Yi Ying?
Thanks, Alvin. To answer your question, I think we have covered quite a bit in the presentation just now that China exports are in fact it's actually increasing, and Southeast Asia is the largest export market for China right now because of the low freight rates. Right now, China's self-sufficiency for PP is about 92-93%, and in the span of 7 years, it's going to add up to 2026 is going to add another 15 million tons of new capacity. So definitely it will impact Southeast Asia prices in the sense that the converters in this region are already looking at Chinese supplies as a cheaper alternative whenever Southeast Asia supply tightens. We have already seen this in December last year when Indonesia actually takes up all imports in Southeast Asia because of the earlier stock before the import mandate is actually dropped. So other converters in other regions in Southeast Asia like Thailand, Vietnam, Philippines, Malaysia, they have actually turned to import from China PP. So Chinese PP prices, I would say it will have a strong influence on regional Southeast Asia prices. The gap between dutiable and duty-free prices could actually close. But I think what the Southeast Asia producers are looking at is they are also looking at switching production to other grades like CPP film, non-woven fiber, and copolymers for better netbacks, and they're cutting down on the raffia grades, which it's heavily produced in China. And it's also difficult for the converters in this region to actually switch suppliers for these specialty grade for China origin cargoes. But yes, definitely it will put pressure and close up the gap between dutiable and duty-free cargoes coming into Southeast Asia.
Would we okay, the first question from myself is when do you see China reaching self-sufficiency for PE and PP? Your calculation.
I think right now they are 92% self-sufficient, but we heard from China Plus where I attended last year, it's challenging for some of the specialty grades to be replaced in China, which means they will still need a small amount of imports coming in, especially for specialty grades, and that's the small portion of like 5 to 8%, which they might not be able to achieve. In that sense, they would still have to import from other Middle East suppliers, from the Southeast Asia suppliers. But they in the next couple of years, their self-sufficiency rates will actually continue to climb to maybe maxed out at 92%. At the moment, it seems like it's gonna be flat at 92 to 95% in the next few years.
The question is, when are they going to be self-sufficient and be a net exporter?
Right now,
5 years time?
Right now, I think we will have to go back to consulting data at the moment. But right now, with consumption in China growing by just few million tons a year, and as in 2 to 3 million tons in the past few years, and they have been adding like maybe 5-6 million tons a year. We consider China a threat as a net exporter to the whole Asia market.
I think we see from Rita's presentation just now that China is probably net exporter for PVC already. Yeah, but we will address that question to Rita later on PVC. The next question is to Rita anyway. With India potentially placing import restriction on PVC from China, do you believe that Chinese PVC will move to Europe?
Hi, thanks, Alvin.
Rita, before you answer, can you please put on your video?
Oh, okay.
Yeah,
Okay.
thanks, Rita.
Thanks, Alvin. China has been developing European market, but according to the export data, we are seeing a very small percentage of around 1% of China origin PVC has been exported to Europe. And almost 85% of PVC in Europe was contracted on contracted basis, mainly from domestic market. I wouldn't deny that it will increase more PVC exports to Europe, but I would like to say still need take step by step in the long term. As firstly is the big issue is the BIS imposed in the near term, so it might change the flow. Trade flow in the short term, but to the exports to Europe still need long term to change their stereotype of this, to change find a substitute from China. I hope this can answer your question.
From your presentation, I can see that China has been a very big exporter. Has China reached self-sufficiency for PVC and become a next exporter?
Yes, the PVC exports has started 10 years ago, or I cannot have the which date have exact date, but it has been exporting for more than 10 years. So that's a long history that China has to become the net PVC exporter since 2021 because of the supply issue occurred to US producers because of the winter storm that pushed China to become the net exporter since then.
Okay, thank you, Rita. Next question is to Akash. Question is, can recycled polymer claim the credits? I suppose this refers to carbon credit, specifically referring to the post-industrial waste plastic.
So, sorry, Mr. Alvin, carbon credits or plastic credits?
I'm not sure. It says credits, but what's the difference between carbon credit and plastic credits anyway?
Well, effectively it functions in the same way, but plastic credits are basically if you purchase a plastic credit, you offset, well, one plastic credit is equal to 1 ton of plastic waste. So it's offsetting in the same way you would offset a unit of carbon. But if I could perhaps answer this question tailored towards the plastic credit side, I think that's more relevant. I think that's what it's going for. The answer is
You
yes.
calculate 1 unit of plastic credit compared to carbon credits. I understand that carbon credits you calculate by kilogram of CO2, right?
Yes, that's correct. But I'm saying specific to plastic credits. I'm not saying it's equivalent, but it functions in the same way.
Yeah, how do you equate that the units that is used? Probably you mentioned ton of plastic recycled. How do you equate that to kilogram of CO2?
Well, I don't think it's necessary to equate that because it's actually tackling two different issues. And plastic credits are to deal with the plastic waste solution issue, and carbon credits are to offset carbon. So I don't think there's necessarily
So for example, the MNCs, they will have different targets. One target for reduction in plastic or increase in plastic recycle consumption, and another for carbon credit reduction, carbon CO2 emission reduction, I mean.
yes.
Okay. All right, the next question is addressed to Yi Ying. What is the short-term price forecast? I would assume that PE and PP prices for Southeast Asia. Short-term forecast.
Thanks, Alvin.
Yi Ying,
yeah,
can you please put on your video?
Yeah, sure. Okay, so we do have price forecast services by our analytics team. Yeah, so we have that available, but it's done by another team. So for my own personal opinion, like what I mentioned earlier on Southeast Asia, LL and PP prices are already the highest in Asia, where demand in this region, I don't seem to hear that the demand is doing very well at the start of the year. So prices are now under pressure, and I will not rule out the possibility that prices will start to dip in second quarter. So to give you a bit more for Southeast Asia especially. So for Southeast Asia, there's a heavy maintenance schedule in second quarter, which could help keep duty-free prices high. But of course, and also of course, PrefChem and also Longson, in the short term, we are not expected to see supply from this new capacity, at least for the next 2 months, because of their cracker maintenance and also unexpected shutdown. But let's not forget what happened in December last year when Indonesia takes up all the PP imports from this region, and converters in this region have turned to Chinese cargoes, and that actually puts pressure, a cap to how much Southeast Asia prices can go. So in March and April, just for the month of March and April, there will be 1.5 million tons of PP capacity, which are planning to start up. But I've shown you a long list of maintenance in China, but prices are still weak in China, which shows that actual demand is needed in order for prices to be sustained at current price level. But also producers are also seeing squeezed margin, which is why they are actually most of the producers are running at reduced rates just to manage their inventory. Demand is seasonally weaker in second quarter, but India demand will likely return in April during the first month of their fiscal year, so that could help support Asia prices. But the Middle East have actually conducted heavy maintenance in first quarter, and they are going to restart their plants soon, which means there might be more supplies in second quarter. So prices is definitely under pressure, and it could fall from the current highs. But for polyethylene at the moment, this year we don't expect a lot of new capacities coming up in China, and new supplies in the region are also not ready to produce consistent volumes to the market. So PE prices are still more or less stable at the moment, but PP prices are under pressure.
Okay, thank you. So do you see this sustaining into next year?
Do you mean prices?
Yes, your crystal ball.
Yeah, I wish I have a crystal ball, but to me, I personally see that there's a potential for prices to dip below what we are seeing right now, definitely, because that has already happened in 2023. But because of all the sudden import mandates in Indonesia, that has pushed up prices in this region to become the highest in Asia, which definitely I don't think demand in Southeast Asia is doing that great. So there's a lot of room for prices to actually fall. But at the moment, we don't see at the moment, new capacities are not stable, and that's why I think regional producers have also been suffering from poor margins in the past, I think since 2022. So they are less willing to compromise in terms of margin, and I've heard that the producers, especially the Thai producers, are actually willing to shut down the plants to balance up the inventories or operate at a lower rates. Yeah, so prices will definitely be under pressure, and there's more room for prices to go down, in my opinion, my personal opinion.
Wow, the producers are shivering listening to you.
Yes, but I think feedstock prices are still supporting the market, of course. With naphtha and crude prices, there's little room for them to actually reduce the prices. But now we don't see a lot of new capacities, but once the new capacities come online, there will be a strong competition, and there will be time where prices go down after when producers try to get rid of their inventories, and before it will rebound again. So we will see slight rebound and a slight dip, but prices will remain suppressed, as what Rita mentioned earlier, also on PP prices in China, for PP especially.
Okay, all right, thank you.
Calvin.
Next question is to Akash. With the increasing focus on sustainability and environmental concerns, how are the prices of bio-based or recycled plastic raw material being affected in the polymer market?
So I think I touched on this in my presentation as well. The increasing focus on sustainability is supporting, well, one, feedstock costs for mechanical recycling. So we're seeing the industry is a bit more safeguarded. I'm sorry, the price is a bit more safeguarded and less subject to changes in virgin polymer prices. So it's happening slowly. So it's a matter of time. It's like I mentioned, I think once the regulation comes into place, we'll really see this in effect. But with regards to the first part of the question, bio-based, I think this is a very largely unregulated market, and it's even more nascent than recycled polymers, mechanical recycled polymers, or chemical recycled polymers, which is what people are talking about these days. And I think since chemically recycled polymers have been, or pyrolysis oil, the product, has come into place in the last 4 years, there's still no unified, generally agreed upon standard on how to actually do the pricing. And since bio-based polymers are even more recent than that, I think it would be a bit unrealistic to come up with a methodology or a way of pricing this at this point in time.
Have you experienced pyrolysis-based polymers, chemical recycled polymers in the market? Have you seen them?
We are seeing them. So pyrolysis oil, it is being used, it is being sold, but it's depending on the application really. So the idea behind it is that it can be reproduced back into chemically recycled polyolefins. But like I said, because it is unregulated and there's some disputes on whether it is suitable for food contact based on the process that it undergoes to actually recycle it. It's a bit uncertain at the moment, and the other use that it's really being used for in light of that, because there's no regulation, is it's being used as a fuel oil for combustion purposes. So again, the main thing supporting this would be the development of regulation, which is supposed to come into place by the end of this year in Europe, and then we expect that the US and Asia will then follow suit.
In your view, how realistic is it that some producers are talking about selling chemical recycle polyethylene certificates? They're selling virgin material, but they're selling certificates when they have, say, a capacity of 200,000 ton, 200,000 KT of pyrolysis produce resin a year, and they're selling their certificates at 2,000 or at 1,000 or two. I heard maybe $1,000 above C4 prices for PEs.
Well, I think it is realistic because the reality of the fact is we have to face that there is going to be a premium associated with this. The development of the industry, the goals it's trying to achieve to actually help a real circular economy, it doesn't come without a price. So if we really want this to work, people have to be willing to pay.
Yeah, but the multinationals are not at the moment. They see the certificates value for chemical recycled resin, and they say, "Don't give me that."
Well, yeah, it is definitely a matter of time before it happens. We're starting to see some headway towards this, but I think it'll be a few years. Also, once the technology itself develops, like I said, it's very new, it becomes more efficient, more cost efficient by many ways. Many things can be improved, but there's a lot of legislation and safety standards that have to be gone around in order to make that happen, which does take time. So it's not saying that it will not happen, but it's just a matter of time. that's my personal opinion.
Okay, thank you, Akash.
Pleasure.
We have a question to Matt. How do macroeconomic factors such as currency fluctuations or inflation impact the pricing of plastic raw materials in the polymer market? And what strategies can businesses employ to mitigate this risk?
Oh,
Current situation and inflation.
yeah, that's a good question. It's a two-pronged question, so I'll address the first half with respect to the effect on the markets. I would say it will greatly impact buyers' purchasing power because when, let's say, interest rates in the US go up, then access to US dollars becomes harder. It's more expensive to borrow US dollars, which will in turn cause other currencies to depreciate against the US dollar. And so, when buyers in developing economies like, let's say Bangladesh, for example, are trying to get LCs to import more raw material, it's going to be very difficult because the cost of borrowing is going to be high. So initially, because of the higher interest rates, right, we will see that after a while, demand will start to fall off because access to credit gets more expensive, and buyers will probably resort to buying as needed instead of overstocking like what we used to see back in the day. Maybe previously, from what I've been hearing, also buyers would keep maybe 4 months worth of inventories, but now they've reduced it to maybe 2 months in certain regions. So this is one way in which inflation has affected the polymer markets. Um, some even say that actually it's the other way around. Raw material pricing is the cause of inflation, which is also possible, and I can also see why some would think that. If we look at what happened in 2021, plastic raw material prices were really high, and that meant that consumer goods prices would go up, which would obviously raise the CPI after that and cause the inflation. So it's a chicken and egg situation, I would say, in terms of the relationship between inflation and raw material price, plastic pricing. Yeah, and so generally when prices get too expensive, downstream demand falls, converters orders fall, and cost of borrowing goes up. So the restocking volumes will fall as well as the currency depreciates. Yeah. And onto the second part of the question, what can businesses do? Frankly, Elvin, if I could give you the perfect answer to this, I would be a billionaire right now. Because I'll be perfectly able to hedge against all of these macroeconomic shocks. And yeah, I would just basically be very, very rich. But I guess, in light of recent times, maybe, bigger industries, bigger converters, or even like FMCG companies, they can consider expanding their FX and rates teams to do more research and look at possible hedging strategies in order to ensure that they don't get burnt by the appreciating US dollar. I think this is probably the most practical way of navigating this difficult macroeconomic challenge. Yeah.
All right, thank you, Matthew. We are opening up the floor to the participants to put in their question in the chat box. If there's any burning question, I can see that there's still 53 participants. The final questions that I have here is to Akash again. With the increasing focus on circular economy initiatives, how are companies incorporating sustainability and recycling into their pricing models for plastic raw materials in the polymer market? How does companies incorporate pricing models?
Well, I think that's quite similar to the previous question, actually, and the answer would be the same. It's companies are really, well, it depends whether you're looking at, well, what grades you're looking at, right? So like I said, if you're looking towards your higher grades, so your recycled PE, PP, white or natural color, you can afford to pay a premium for this. So it's subject to, well, a premium to what's happening in the virgin side. But if you're looking for the lower grades, so your RPE and RPP black, you are very much subject to the vagaries of the market. If there's a reduction in virgin prices, your pricing strategy will naturally have to drop in the same way. So it depends on what kind of material you're looking to sell, who your customers are, what the exact specifications of the grade they're looking for. So it's difficult to give a wholesale answer to this because it's there's a very wide spectrum of grades and recyclates that can be applied to. But generally speaking, that's what I would say.
Okay, thanks, Akash. I've got a question for probably anyone who wants to pick it up. It's regarding price difference, I think to Yijing probably. Price difference between high olefin grade, the metallocene grade, C8, C6 of PE and commodity C4 for PE. How do you see the gap? We've seen the gap increasing, the delta increasing to about 100 to 150 US dollar per ton in recent times, the past probably 6 months. How do you see this? Is this gap gonna grow wider, or is gonna go back to less than 100 like previously? High alpha.
Thanks, Alvin. Yeah. So the question is whether we will continue to see a spread between higher alpha olefins polyethylene compared with the commodity grades. I think current rates are, I think there's a possibility that it might fall to the previous rates that we are seeing. Reason because US have a lot of new expansions and there will be more metallocene supplies coming into this region in the next couple of years. And that should actually put pressure on prices. And also with the amount of I think in this region we don't see a lot of metallocene production that's serving the converters over here, but we have seen different tiers of producers in this region, and some producers are selling their metallocene grade with a gap of just very thin gaps of $20-$30 above the commodity C4 grade. But I also want to say that because the region is getting more and more saturated, the Southeast Asian producers are also exploring on producing metallocene LLDP. So that should put pressure on prices, and eventually the lower price gap that you are seeing earlier on, it might happen again, but very likely it will happen from 2025 onwards when new capacity ramp up. I think we also have a new Nova chemical plant in the US which are coming maybe later this year, which is expected to come online last year, but it didn't happen. So we will have more supplies coming to Asia because of the new expansion in the US. But thankfully, we don't have a lot of metallocene production in China, not at the moment, and so we don't see an influx of cargoes from Northeast Asia. And for Koreans itself, at the moment there are some cargoes, but we don't see that high influx into this region that will impact prices. But there's a possibility, of course, for prices to narrow, especially in this kind of situation where all the where everything is under pressure at the moment. The sentiment is actually a bit more bearish at the moment, but we hope for a better recovery in the second half this year.
Wow, no wonder you don't work for a petrochemical major. Yeah? You're very pessimistic. Anyway, yeah, Nova in Canada, solution based, will be very interesting. I think give a run to Dow. I think they're coming up with C8 materials there as well. Yeah. Talking about North America, do you see the price? How do you see the price difference between local USA market, which is mostly rail delivered, and Mexico prices in Mexico, because a lot of investors has been moving to, especially from China, moving to Mexico, and of course their end market would be US. How do you see the price difference?
The price difference between Mexico and the rest.
Mexico, yeah.
You mean the resin prices going into Mexico? I think Latin America and Mexico especially is already under pressure because they have been getting a lot of PP supplies from all other origin. But of course, in terms of US domestic market, I think typically US producers traditionally will export 1/3 of their production, especially to the Latin America market. And that helps them to balance out the supply in the domestic market, which will help keep prices high. Um, there will still be a gap between US domestic prices compared with the rest of the world because I think right now it's a bit challenging for producers to actually export into the US. But of course, with this overcapacity situation, producers are also exploring into export to US because there are some logistical issues that you will have to handle before shipping to the US. But in terms of Mexico, I I think right now the gap, Mexico price, as in Latin America prices have come down a lot since the after the post-pandemic because the freight rates have also come down a lot. So yeah, in the event if you have any questions, then I can also get back to you if you have further questions about the prices in the Mexico because I probably don't have the prices in my mind right now, but I think during the pandemic, the prices have surged to more than $400 above Asia prices just because of the additional freight costs that we are seeing. But with supply issues being managed better right now, I think the market is also it's also seeing its prices coming down at the moment. Yeah. And yeah.
Why is it that you think North American producers with the excess capacity and all that and more coming, they are selling at very high in the domestic market and exporting it at very low? Of course, there's a rail car barrier there. What do you think? The US converters, would they be buying bags from the rest of the world and just feeding them? If the price gap gets too big?
I think the reason why domestic prices in US have stayed high is because it's difficult for any producers in the world, say for example, Middle East producers or Chinese producers to actually export to the US because US is a net exporter by nature. So there are some logistical issues that we know that prevents producers to actually export to the US at the moment. But eventually, the converters in the US will also try to get materials from other parts of the world, and prices will also be under pressure because I'm just giving you an example. We heard last year that the Middle Eastern producers are actually doing a pilot study to actually refer to Southeast Asia prices to price their domestic market in Saudi Arabia, which is still ongoing for 6 months. And the reason why they are doing so is because it's just to help the local converters to become more competitive because domestic prices have always been high and export prices sometimes are more competitive. So just giving you an example that the converters are already coming, will eventually start to look at other opportunities all over the world, resin from all over the world.
Okay, thank you. We have no more questions. There are still 48 participants. Thank you for participating. Back to you, Francis.
Thank you so much, Alvin. Thank you so much. Can we have the QR code slide once again? Girls? The QR code slide? Yeah. Okay, once again, we want to end the session by showing you the QR code to all the participants to access free sample reports or to find out more about Argus Chemical Services. So all you have to do is just scan this QR code. And with that, we want to thank everyone for being with us this morning. We want to especially thank the Argus team for your insightful presentations. And we also wish to thank Mr. Alvin Ang, our moderator for this morning, for taking the time to be with us. And with that, we end today's webinar and we wish all of you a great day. Thank you so much.
Thank you, everyone.
Thanks, Akash.